We all invest with the idea to make a profit and limit the losses. And it sounds very reasonable and rational, but investing for most people is all but rational. Why? Why is it difficult to remove our emotions from investing decisions? Well, the answer is very simple. We humans, we don't like losing, especially when it is our hard-earned money. Believe me, if you were making decisions about someone else's money, there would be no emotions. You would be able to make a very rational, well thought through decision about what is the best course of action in a particular situation. But because it is your money, your hard work, your nest egg, most people are unable to separate thinking from feeling, and the feeling will always win. Even if that leads to a very detrimental decision that can negatively impact your life for a very long time. What's worse, we are able to always justify our decisions, even or maybe I should say especially the wrong ones. It makes us feel better, but it does not improve your bank account if you already lost your money due to wrong judgment or wrong decision or wrong timing. My name is Catherine Isbrand from About Retirement. I'm certified financial planner, and you are watching About Retirement TV, the place that I created for all people who are preparing for retirement or who have already retired and want to improve their financial position to have a better lifestyle, better income, and better financial outcomes for life. And today we are talking about the subject I am quite passionate about. Investing with emotions can be very costly. Just recently I did a video investing into shares. How risky is it? That touches our today's subject, although I was talking purely about investing into shares as separate asset class. In general, we all love investing when things go well. As a matter of fact, we often think, why didn't I invest more? Why was I hesitating with my investing decisions? Some of you might even think, why haven't I borrowed money to invest even more? Why are we thinking that way? Well, it is our fear of missing out. We want more of the good thing and, of course, those positive returns. But if we just turn the table and the market starts going downwards, meaning we start losing money, now we want to limit our losses and we start irrational behavior of selling investment in a most depressed market, which only creates the financial loss, regret, and resentment to investing. This is exactly what our emotional behavior looks like in a rising and falling market. Let's just analyze this drawing. Well, we have funds ready to be invested, but we wait until we get confirmation from the market that it is safe to invest. Therefore, we go through those emotions of feeling encouraged, confident, and then thrilled. And then the action time. We buy our investment with full euphoria. Then the market has been so positive. But we waited too long. The market already had its run. And now, just after we invested our hard-earned money, we feel surprised. What just happened? Why the market has just changed? And we become nervous and worried until it comes to a panic mode. Then we cannot accept those losses any longer and we sell. But it is too late. Now our sale just means we accepted all the losses. If one goes through such emotional roller coaster every so often, no wonder at some point you had enough. So let's see what is the difference between a professional, unemotional investor and a person that acts emotionally and follows the herd of buying when others are buying and selling when others are selling. When looking at 3-year return between 1993 and 2021, the following the herd investor has returned approximately 5.5% per annum, while going against the herd would provide a return of 15%. But let's be honest, most of us would not be able to get the market timing right every time. But if you only control your emotions, stop acting like everyone else. Take a deep breather and just not do anything. Your average annual return of just the S&P 500 index would have been 10.75% per annum. Okay, it is not an Australian index, but rather top 500 companies in US. But the message remains the same. Stop acting emotionally. The trick is to understand the motivation behind emotional investing and avoiding both euphoric and panic behavior and traps that can lead to very poor investment decisions and ultimately negative investment outcomes. And if you cannot do it, or if you would like to do better than an average, make sure you work with an advisor who can assist you in building a well-diversified investment portfolio and will spend time with you to change your way of seeing the market. And rather than seeing something as negative and a loss, view it as opportunity and growth. And this is exactly what I see is happening today. We had pandemic. Fortunately, the worst appears to be behind us. There is a huge problem with inflation, and each part of the world is dealing with it differently. But it appears that inflation should start to decelerate over the coming year. And of course, the war in Ukraine, where the outcome appears still uncertain. But just look at the graph of the history of the market and all the crashes along the way. We always see the one that impacts us the worst, but if the history is of any indication, all passes and the market will start rising again, ever greater than before. As Winston Churchill said, the pessimist sees difficulty in every opportunity. The optimist see the opportunity in every difficulty. If you enjoyed this video, please like it and subscribe to my channel not to miss my next video. Also, don't forget to visit my website about retirement.com.au, where you can find lots of information about investing, especially when preparing for retirement or if you have already retired. And when you are there, please sign up to my newsletter to keep up to date with all the changes that can impact your retirement planning. You can also book a meeting with me directly on my website if there is a specific issue you would like to discuss or just simply you would like to receive a full financial planning strategy. Now please watch that previously mentioned video, Investing into Shares, How Risky Is It? I think it is a fantastic way of looking at share investing as part of your overall portfolio. The second video I'm recommending is Property Shares of Super, which one is better? A well-known debate which is exactly like old-fashioned debate, which one is better, Ford or Holden? Well, I rest my case. I will speak with you in my next video. Bye for now.